Welcome to Money and Markets, Series 1, Lesson 5. This episode is called Variable Rates and Flex CDs. In Lesson 4, you learn to read the yield curve. Spot rates, forward rates, discount factors. All of that assumed you knew the rates today, and they stayed fixed for the life of the investment. Now, we remove that certainty. What if the bank can change your rate? What if the interest you earn next month depends on what the central bank does between now and then? That is a variable rate, and it is one of the most common features in everyday finance. Your savings account, your mortgage, your credit card. Many of them have rates that float. This episode teaches you how to think about that trade-off. When floating helps you, when it hurts, and what questions to ask before you sign anything that says variable. So what does variable actually mean? It means the interest rate on your product is not locked for the full term. Can move up, can move down. The rate is usually built from two pieces. First, the index. This is the moving part. It tracks something outside the bank's control. The federal funds rate, a market benchmark, a published policy rate. When the central bank raises rates, the index rises. When they cut, it falls. Second, the spread. This is the fixed part. It is the margin the bank adds on top of or subtracts from the index. The spread is written into your contract. It does not change, so your effective rate at any moment equals the index plus or minus the spread. The key word is at any moment. Because the index moves, your rate moves. And because your rate moves, you cannot know in advance exactly how much interest you will earn or owe over the full life of the product. That uncertainty is what makes variable rates different from everything we have built so far. Let us make this concrete with an example. You walk into a bank with $1,000. You open a 24-month Flex certificate of deposit. The bank says, "We will pay you whatever the federal funds rate is, minus 0.3%. That minus 0.3 is your spread. It is locked for the full 24 months. The federal funds rate is the index. It moves whenever the central bank acts. On the day you open the account, the federal funds rate is 3%. Your spread is minus 0.3. So your CD rate right now is 2.7%. Your money sits in a secure, FDIC-protected account. Up to $250,000 of insurance. The principal is safe, but the rate you earn on that principal is not fixed. It will change every time the federal funds rate changes. We simplify the interest calculation to simple interest for this example. In practice, most CDs compound monthly, but the logic is the same. Each period, your interest depends on whatever the current rate happens to be. Now watch the rate path unfold, step by step. Day 1. Federal funds rate is 3%. Your CD rate is 2.7%. You are earning interest at that pace. After 1 month, the central bank raises the federal funds rate to 3.5%. Your CD rate jumps to 3.2%. You did not do anything. The bank adjusted automatically because the index moved. After 6 months, the federal funds rate has climbed to 4%. Your CD rate is now 3.7%, higher than when you started. You are earning more interest per month than you were at the beginning. Then, after 12 months, the central bank pauses and the rate dips slightly to 3.8%. Your CD rate drops to 3.5%, still above where you opened, but lower than last month. And so on, and so on. The future path is unknown. You can estimate with assumptions, but you cannot compute with certainty. That is the fundamental difference from Lesson 4, where every spot rate was known today. Here is why this matters. The interest you receive each month depends on a rate, R sub t, that is unknown in advance. The subscript t means the rate at time t. And because R sub t is unknown, You cannot calculate your future interest or your ending balance with certainty. You can estimate. If you assume the federal funds rate will stay at 4% for the rest of the term, you can project what you will earn. But that projection is a guess, not a guarantee. This is a big shift from the earlier lessons. In Lesson 1, you learned future value with a fixed rate. In Lesson 4, you priced forward rates from known spots. Both of those were deterministic. You knew the inputs so you could compute the output exactly. With a variable rate product, the inputs themselves are uncertain. The math is the same multiplication, but the numbers you multiply by are not known until they arrive. Much of finance is decision-making under uncertainty. This is where that theme begins. So when should you choose variable and when should you choose fixed? Here is a framework, not a rule. If you expect interest rates to rise, a variable rate may serve you better. Your rate will climb with the index, and you will earn more interest than if you had locked a lower fixed rate at the start. If you expect interest rates to fall, a fixed rate may serve you better. You lock in today's higher rate, and you keep earning it even as the market drops. That sounds simple, but it is never that simple, because your expectation about rates is just a guess. Central banks surprise people. Economies surprise people. The path of rates over 24 months is not something anyone predicts reliably. And there are other factors. Do you need the money before the term ends? CDs can have harsh early withdrawal penalties. Is the spread competitive? What floor or cap does the contract include? What are the tax implications of receiving variable interest? There are 3 decisions for any deposit. How much principal? How long to lock it up? And fixed versus variable. Even a simple savings product has 3 moving parts. Now flip the coin. Everything we just said about savers has a mirror image for borrowers. Mortgages are a perfect example. A mortgage can be fixed rate or variable rate. Same 2 pieces, an index and a spread, but the objective is reversed. A saver wants a higher rate because higher means more interest earned. A borrower wants a lower rate because lower means smaller monthly payments. So a borrower who expects rates to fall might prefer a variable mortgage. If the index drops, the monthly payment drops with it. A borrower who expects rates to stay high or rise might prefer to lock a fixed rate now to protect the household budget from surprises. The math is identical. The same index plus spread structure. The same uncertainty about the future path. The same 3 decisions: how much to borrow, how long, and fixed versus variable. The only thing that flips is the sign. The saver receives the rate. The borrower pays it. Same machinery, opposite direction. Before you sign anything with the word variable in it, ask 4 questions out loud. Question 1. What is the index and what is the margin? You need to know which benchmark your rate tracks and what fixed spread sits on top. If you cannot name both, you do not understand the product. Question 2. How often does the rate reset? Daily? Monthly? Quarterly? The reset frequency decides how fast your realized return chases macro news. A lag can help only the bank. Question 3. What are the penalties? If you need cash before the term ends, what does it cost to break the contract? Flex CDs may offer early withdrawal, but that flexibility is priced, usually in a lower yield than a rigid sibling product. Question 4. How is the interest taxed? Variable interest hits your tax return as ordinary income, but the timing can vary by product and jurisdiction. After-tax yield is the number that actually reaches your kitchen table. These 4 questions apply to savings products, mortgages, and any financial contract with a floating component. Write them down. Step back and see where we are in the larger picture. Lessons 1 through 4 built your arithmetic. Time value of money, compounding, inflation and real rates, spot rates, forward rates, discount factors. All of that was deterministic. You knew the numbers and you computed the answer. This lesson introduced uncertainty. With a variable rate, the future inputs are unknown. You can estimate, but you cannot guarantee. This is the beginning of a deeper theme. Much of finance is decision-making under uncertainty. Forward rates from Lesson 4 are consistency conditions. They tell you what rates must be if no one gets a free lunch. Variable rates are what actually happens when the world moves and the curve shifts. That gap between the model and the reality is where all the interesting work lives. Every tool you pick up from here forward, whether it is risk management, derivatives, or portfolio construction, is about navigating that gap. For now, the practical skill is simpler. Read the contract, understand the index, understand the spread, and respect the fact that you cannot predict the path. 3 takeaways to carry forward from this lesson. 1. A variable rate means the index floats and the spread is fixed. Your effective rate changes over time, and you cannot compute your future balance with certainty. You can only estimate. 2. The choice between fixed and variable depends on your rate outlook, your liquidity needs, and your tolerance for path risk. There is no universal answer. 3 decisions for every deposit. How much, how long, and fixed versus variable. 3. The same structure applies to both sides. Savers earn the rate, borrowers pay it. Same index, same spread, same uncertainty. The only difference is the sign. Next lesson, we ask a question you have probably wondered about your whole life. Why does the bank pay you 3% on your savings, but charge you 7% on your loan? The answer is the bank spread, and it is not as simple as greed. I will see you in Lesson 6.